It's November, and I'm here once again with former fund manager and investment analyst Ken Baksh to give us his ideas on the markets, on the background macro picture, and of course, some stocks that may or may not have caught his eye. So I'd like to say at this point, of course, that the stocks we discuss and the ideas we discuss are not specific recommendations. It's not an inducement to buy. You should do your own research, and also we may have or we may not have positions in the stocks mentioned. So Ken, once again, welcome back.
Yeah, thank you, Alan. It's good to see you.
Good to see you too. So it's so much has happened since we last spoke. Trust and quasi-carting, of course, now ancient history in political terms. We have Rishi Sunak this week at the COP conference talking about clean energy. But can you summarize for us what's happened and what are the global investment implications for this, and also what asset classes have been moving?
Yeah, sure, Alan. Using the same format as last time, we'll look at the world and then homing onto the UK, the next section. World growth has slowed, even compared with last time. And this is largely because of China, which came in with figures lower than expected. The US is still growing, but more slowly. Europe, continental Europe, is technically in a recession. And the UK, on a monthly GDP figure at the end of September, tipped negative. And it's quite likely we're going to be in that situation for several months. And if you believe Andrew Bailey, our own central bank governor, could be several quarters. So growth is definitely not picking up. Next issue, inflation. We've had 2 or 3 sets of figures over the last month relating to September figures. One of them relates to October figures, but they're all of the order of 8 to 10%. So 3 or 4 times, most or 5 times, central bank target rates. And some of the components, it might have started with fuel prices, but it's feeding through into other areas, such as food. In the UK, for example, Kantar, one of the organizations which monitors food prices, shows 15% inflation in food. A further thing we have to worry is what's happening to labor costs, which could feed through into further inflation. We've seen strikes happening here. In Germany, we have the IG Metall looking for a 10% wage increase or so. These would have a dramatic effect on future inflation. So inflation is also at unacceptable levels. Both Fed Jay Powell and Bank of England Andrew Bailey hinted at their last press conferences that rates could stay high, maybe not as high in the UK as the emergency trust level, but high for a little bit longer. So we have to be aware of that in our planning and in our investment assumptions. Leads us on to interest rates, where the UK, Europe, and America all raised 75 basis points over the last week or so. 75 basis points would have been unheard of earlier this year. It's become a norm now. In fact, some people were even looking at 1%, 100 basis points. So their central bank mandate is still to get a grip on the inflation I was just talking about. And then until they see signs of that coming down, the pressure will be upwards, and we will get further rate increases this year, hopefully topping out by next spring, but a lot depends on the inflation figure.
Of course. So if we turn to the UK now, Ken, obviously seismic developments here over the past few weeks politically, but I think a little more certainty has come into the market, hasn't it? At least there's greater visibility, because I think when Rishi delivers his budget on the 17th, we should have a much clearer picture of where we're going, even though it might be painful medicine. What are your views?
Yeah, I think you're right in the sentiment certainly the sentiment compared to when Truss and Kwarteng were briefly in control. But the actual figures to date, and you have to remember, this is what the OBR will be looking at when they compare the Hunt Rishi forecast with their own, are still quite weak. We have consumer sentiment figures, which are often more live than official GDP data. So we have these going to late October, and they're still reaching new 20, 30, 40-year lows. And if you remember from last time, the consumer is about 65% of our economy, the UK. So that's important. We had this morning a figure from the BRC, the British Retail Consortium, which showed that shop sales were up something like 1.5% year on year. So that's this month compared with the month last year, 2021. On the face of it, you think, well, we know we're slowing. That's okay, 1 point something. But that was the value of the shop sales. If you think that prices were rising at 10%, the actual volume, the stuff we're physically buying, was down something like 9 or 10%. Now, that's quite a scary figure. Talking to retailers, some of these is big items, furniture, cars. In some cases, it's feeding down into more basic food, etc. So a serious reduction in what people are spending. If we extend to the rest of the economy, so we've done the consumer, exports, remember, a lower percentage, and they're not doing that well anyway. And government's expenditure we'll come on to when we talk about the tactics. They're not going to be in any great mood to spend on increased wages or new rail plans or hospitals or roads. Where's the money coming from? So consumer, exports, public expenditure, low. At company level, insolvencies are rising, something like 50 or 60%. Again, we mentioned this last time, and I actually recommended a stock which is sort of black humor, really. It's a beneficiary of that trend. But companies are being squeezed. Sales are going down for the reasons we've talked about. In a lot of cases, costs are going up. I mentioned in the review there was something like a dozen headwinds consumers were facing. And I think as the days go by and we get into these next few months, it seems to me, and everybody has their own situation, that it's sort of death by 1,000 cuts. Whether you're running a small business and it's Brexit-related admin, extra computer costs, extra people, or something related to commodity prices or transport. I was looking at a car yesterday. My 12-year-old 120,000-mile Volvo is giving up the ghost, and I'm just starting to do some preliminary research on the replacement. And although I would not use a finance lease agreement, I asked the guy out of curiosity, because a lot of focus on mortgages, but what about cars? It's a big item in some people's expenditure, and they may have to buy something. And he said, well, about a year ago, a finance deal, the rate, I know there was some noughts advertised, but maybe 2.4%. This particular company is now 6.5%. And then he sort of whispered quietly, but we may be going up to 9.99 over the next couple of weeks. So this is another item which could tip you between buying a car or not, or trading down, or squeezing other parts of your budgets. So my point is, squeezes coming all round, and the UK economy is still on the ropes. Now, leads to the next question. We have to find some ray of hope, if you like. Sunak and Hunt are trying to get some confidence back into the financial system, which would keep inflation perhaps more under control and bring interest rates down to encourage more domestic spending where there's funds available, B, the ratings agencies to look at the UK and said, right, Fitch and Moody's say UK is now on a better course. I don't know, AA rating rather than a BB plus. In other words, the ratings they give to UK Treasury stock are maintained rather than dropped, which affects everything. It'll affect long-term rates, your mortgage rates, the currency, everything. So that's what the Sunak and Hunt are trying to do. The Bank of England, finally, in the background, their mandate is inflation. They see these figures I've been talking about. They raised rates 75 basis points last week. They are going to do another 75 basis points before the end of the year. Spring, their short-term rates, which had been up 5.5, 6, are now down 4 point something. 2 points there. 4 point something is better than 6 point something, but 4 point something is still 2 or 3 times higher than this time last year. So anyone with a mortgage, anyone looking at this car I'm talking about, anyone having to borrow is having problems. One final point, which I can't quite get my head around, it's effects of the pandemic. On the one hand, there may be pandemic savings waiting to be spent out there. On the other hand, there are a lot of COVID-related loans which have to be paid back. I look at the US example, where with their slowdown recently, a lot of the COVID savings, which at one position reached 20% of savings ratio, have now down at 3%. So the Americans had used up a lot of those savings. I haven't seen similar figures in the UK. Somebody else mentioned, as another COVID side, the fraud. If you remember, I believe there's about 5 billion which hasn't been recovered. Somebody was rather cynically suggesting that could be finding its way into expenditure. I can't rely on that. I don't know. But all the other figures suggest a weak consumer environment.
Okay. All right, Ken. So let's focus now, of course, with that macro backdrop, grim reading though it might be. Of course, we are in the middle of results season, both for US companies and, of course, for UK companies. So going to bring a chart up now. What would you highlight and what takeaways can we offer investors and people watching this?
Yeah, a simple graph here. We're in the results season. Most of the UK and American companies have December year ends, and those that produce 3/4 year results, so in September, the figures are coming out now, or a lot of the figures are out. It's interesting to see how share prices are reacting to the actual figures. And the graphs I show there, if you see the top line, the blue wobbly line, is how the net share has risen on average when the earnings beat expectations. So the banks and the brokers are forecasting X, the company delivered X plus a bit. Prices on balance, if you can follow through that rather wobbly line, were unchanged or maybe up to 2% up. This is on the day, and then often it accelerates the days afterwards. However, on the it looks brown to me, but the line below, if earnings missed expectations, stocks were falling on average by about 8%. So there's an asymmetry here. Stocks which do as expected hang in. Stocks which disappoint in earnings terms have large declines in share price terms. Just to think of the American example, there's a number of big tech stocks which dominate the S&P. Facebook's a good example. Not only did they have poor earnings, but they've also been putting a lot of money into this new metaverse, where they will all be wearing headsets, extra glasses next year. I don't know. Not my
down that virtual reality
range of activity. Yeah. I won't be. But they were punished. A lot of shares have dropped 10, 20%. There was a UK company yesterday, Jules, which is exposed to the consumer, and a lot of it is clothing. And they were saying, number one, the consumer's expenditure was weak. Number two, the milder weather has stopped their selling of, I think they said woolies and wellies, jumpers and wellies. The weather wasn't as expected. So they can't control one, but the other is very weak. So, and that stock fell about 15% in one day. So extending that message now to the rest of the sectors, there are some good points. I better start with some because I've been rather negative up to now. Oil and gas have done very well. Not surprisingly, the underlying commodity is now in the $90 to $100 region. Shell, BP, and the smaller stocks have delivered. They've strengthened their balance sheets. They've had earnings in currencies outside sterling. They've delivered above expectations. The share prices have been positive. And these are large chunks of the FTSE, which gets round to my other theme of preferring the FTSE to the all share, which I mentioned last time. I still do. Pharmaceuticals, another area, often seen as dull and not as cyclical, but that's what you want at the moment. Glaxo last week produced figures higher than expected. Now, their business isn't so much related to the economic cycle, it's more a drug cycle. And some of their drugs had been going off patent, and generics come in, sold much more cheaply, destroy Glaxo's profit center. But new drugs are coming through now. They have a particularly good one now on shingles, I believe. Their figures came in better than expected, dividend better than expected, positive share price response. So, for instance, oil, pharma, and in the UK's FTSE's case, natural resources, that's 12, 20, maybe 25, 30% of the index is doing all right. However, on the other side, we have the property sector. And here talking mainly commercial property, so shops, offices, logistics centres, storage centres. The slowdown is hurting. The interest rate increase, because they're often indebted companies, is hurting. The valuation of their properties acts with a lag. That's going to hurt. And then to top it all, I read the institutions, and some of you may hold properties in unit trusts. They're sellers of something over £1 billion worth of properties. So there's going to be overhang in the physical market. And unlike some things which we can trade quickly, this property, as you well know, if you're trying to move, takes a long time. And in fact, longer times at the moment. So property, be very cautious. If you have to, and I've said this many times, go down the investment trust route rather than the unit trust route. Basically, it's a liquidity. Unit trusts have this disadvantage of short-term money flows and a long-term asset. Investment trusts are much better suited for that. So that's property. Retail, the old havens, Sainsbury's, Tesco last week, reporting can't put the prices up much, but their costs are increasing. The costs of the goods they're selling and their labour costs. And, of course, in their case, competition from Lidl, Aldi's and so on. Iceland had a strange one. They're having a profits warning because of power costs. I suppose it's keeping all those refrigerators going. But it's all eating at the profits. Online retailers, ASOS, used to be one of the darlings of the AIM market. It gained during the early days of the pandemic. But both by comparison with that patch and again, declining sales, rising costs, perhaps one or two ethical questions as well, it's really tanking. Another one, home.com. I don't follow that closely, but they've had a warning recently. So retailers, you'd think Reckitt and Benckiser, they're saying people are cutting back on detergents, cleaning their house. They're either trading down to other brands or they're cleaning less. These are all biting away at profits. So there are some winners, there are some losers. As we'll get onto in a minute, if you're in the market, just be very selective and follow the old investment adages, if you like, of spreading your investments, diversifying by company, by industry.
Yes, of course. Well, Ken, you mentioned, of course, that there are some stocks that have caught your eye. And again, I just reiterate the point we made at the start. Of course, this is not an inducement to buy, so please do your own research on these. Of course, it's early days in the process, but we are looking at other ways of delivering this service to you. And I'm going to put a slide up at the end that will give you some contact information in this regard. But firstly, back to the stocks. There are 4 stocks have caught your eye this month, Ken, and I'm going to bring a chart up for the first one now, which is Whitbread.
Yes, Whitbread. Some of you with longer memories will, of course, associate this with the beer, but Whitbread is no longer the brewery. It's mainly Premier Inns, the mid-range hotels. Beefeater, Brewers Fayre as well in the restaurant business, some of which, of course, were conveniently located next to Premier Inns for obvious reasons. Premier Inns had, if you like, a good pandemic in that they kept business going. They were still attracting people who had to move with work. Also, a lot of contractors who were working around the country. Premier Inns was one of their accommodation venues. They managed to use the financing appropriately during the pandemic, raised money at the right time, have kept a strong balance sheet, Whitbread, and then expanded when the pandemic wound down and staycation became a bit of the UK theme. Prices for those of them that use them, I always think of sort of 50, 70, 80 pounds a night sort of thing. Some of these hotels in sort of top coastal points or the Lake District or whatever were into the hundreds, and they were able to charge them. So they survived the pandemic. They've got a strong balance sheet. They also took advantage of weakness elsewhere to buy up other hotel rooms, and they're expanding a bit in Germany, where there isn't actually a chain of this sort of size or this budget. So it's a bit of a staycation, holiday, well-financed theme, Whitbread, FTSE stock. One important thing is they own their own assets. So unlike one of their earlier competitors, this is an asset play as well. So at around these levels, 2,500 or so, it's a stock of interest, shall I say.
Okay. So next stock up, of course, is Frontier IP Group. Can you tell us about Frontier IP Group, Ken?
Yeah, we moved from the FTSE down to the AIM listed. Frontier Intellectual Properties was a company, or is a company, which is basically a high-tech holding company. It provides services to almost startup tech operations, typically universities, where it bridges the gap between the universities and commercial applications. The areas of interest are the things you might imagine: robotics, AI, genomics, other materials, healthcare. Growth areas, and they have about 17, or at the moment, 17 projects on the go. The company, FIP, receive shares in those underlying 17 or 20 companies, for which FIP provide services, marketing services, financial services, partners, economies of scale, and they bring up these small companies. One of them, Excensia, was recently listed on NASDAQ at a price above expectations, which is quite a feat in today's NASDAQ market. It specializes in AI-driven drug discovery. In fact, it's one of the world leaders. So this is that multiple checking drugs using piles and piles and piles of data rather than humans sifting through it. This will be the drug route of the future, and this is a company that has a stake in it. So it's a holding company, and they don't just hold them. If the time is right, they'll IPO them. They'll keep a stake. They still have a stake, but they've IPO'd some, so that gives it a value. They've got lots of these in different interests. They've got machines that harvest fruit, for instance, robotics. They've got graphene. They've got other materials, all high tech, lots of links with very good universities. And it's a holding company, if you like, a tech holding company of the future. The asset value is about 90p. When I started this report, it was about 60p, and I was thinking, well, there's 50% or whatever, 30% undervalued. It started moving, but I think both in the short term and the long term, this is one of the sort of tech stocks you can have, and there aren't many tech stocks in the UK, I should add.
That's very true. That's very true. There are, of course, being based here at the Sussex Innovation Centre, we have spoken to a couple of companies in the same space, but Frontier IP certainly seems to have a larger portfolio, which of course is a better spread of risk. So that's a very, very good idea there, Ken. So on to the next one, and we're looking at Enquest, but of course the bond, the 9% bond.
Yes. Now, if you look at this graph in front of you, you think, and you look at the scale on the left, you think 100 down to 95 and it's wobbled around. Well, that's not too exciting, but let me explain. Enquest is an oil company, main interests in the North Sea with a small interest in Malaysia. A traditional oil company, exploration, production, I believe it's about 50,000 barrels of oil a day equivalent, of which 40 come from the UK and 10 from Malaysia. So it's mainly UK. They're good at what they do on their own business. They're also sometimes acquire fields which are spun off from the majors, and using their superior technology are able to lengthen the life of those fields so they get more out of the other fields. So with oil at $90 to $100, they're having a very good time. The balance sheet is improving all the time. They sell oil forward, so it means that their certain amount of the earnings is guaranteed for so many months out, whatever the oil price does, because that $60 is coming in, and they can sell some in the spot market at 90. So profitable company, strong balance sheet, mid-size. It's in the 250, not in the 100. It's not BP or Shell size, obviously. Now, it has got a share, ENQ is the code, which is quite volatile like the rest of them, but it's on a better trend, and that's interesting in its own right. But they also have a retail bond, which this is. Now, for those of you, most of you, I'm sure, are familiar with the bond, but just to recap those who aren't, this particular bond, issued at 100, matures in 3 or 4 years' time. So you can see it priced at the moment of 90, 98 maybe. So it's going to mature, we know, at 100 in a few years' time. But the real interest in this is if you're seeking income, because the coupon on this bond is 9%. So 9 divided by 100, surprise, surprise, 9%. You're getting 2 payments of roughly 4.5%, one in October, just gone, one in April each year. So if you do the sums, you're going to get 3 or 4 more years of 9% income, plus 2% or 3% capital uplift when it matures. 3 or 4 year run, you're going to get whatever, 9 times this plus that, 30 or 40% return. Nothing's guaranteed. What are the risks? Oil price drops to $20, $30. I don't expect it, but you should be aware of that. Or some sort of corporate fraud or corporate accident. I don't know. But to me, the risk return balance suggests, particularly if you're looking for an income stream, because the capital, I warn you in advance, the graph will always probably be between 95 and 100. And I'll be quite happy at that if it's that for the next 3 or 4 years. If at the same time you're taking 9% income every year. It could be a tax situation as well. So it's an income play, Alan, corporate bond.
Yeah.
It was worth looking at as a special feature.
No, absolutely. And I think, given the challenges faced by investors today in trying to get their investments to keep up with inflation, this is a very good way to do it. So that's a great idea. So finally, we move on to Georgia Capital. Can you tell us about Georgia Capital, Ken?
Yeah, now we're moving into the world of A, investment trusts, and B, emerging markets. And those of you who want to switch off, you can go away now. High risk, high risk. But this one I don't think is so high risk. Georgia, down near the Black Sea, a country which is, you could say, uncomfortably close to Russia, but they have remained independent. Their economy is doing very well and was before the Russia-Ukraine conflict. And in fact, for reasons I'll come on to, is actually benefiting in a way from that conflict. GDP growth is about 10%. There aren't many countries I can say that of. And it's going to, the official figure is going to be announced the next few days, up to the end of September, 10%. Inflation about 8%, which with 10% growth is not a bad thing. So that's okay. The currency, it's not a banana republic. The currency has actually been stronger than sterling and almost as strong as the dollar this year. So you're not losing your shirt on the currency. The company I'm looking at here is called Georgia Capital, which is, if you like, a holding company. Its main asset is the Bank of Georgia, which actually has figures the day after tomorrow, and Georgia Capital has figures tomorrow. Bank of Georgia, and I saw the company just last week, their investor relations in London. Things are going very well up to the end of their September and beyond in terms of growth of loans in that sort of 10% growth environment, interest margins increasing, corporate developments, which is allowing them share buybacks, paying nice dividends, and so on. So Bank of Georgia is one component of the holding company. The other components are in the areas of hospitals, something like 30% of the Georgian hospital industry, educational, a chunk of private schools in Georgia, pharmacy chain. So they're locked into a number of parts of the Georgian economy. Now, the way to analyze this sort of company, like any holding company, is usually the sum of the parts. And when you add together the value of the bank, which is quoted, you can check that as well, which I also like, the bank as well as this holding company. You add that to the values that are attached to these educational or healthcare, you arrive at a price something like 3 times the current share price. In other words, this is on a 66% discount. Okay. I think even allowing for the fact that some people would regard this as an emerging market, I would argue it's quite a successful emerging market. And that sort of level of discount is just too much. Even when, for instance, some other markets in China or which were still quoted, South America, when they went through hard times, the discounts might have been 30%, 40%, but not 67%. It's very topical. Figures are out tomorrow. The bank's out the next day. You can judge it, take a view, do your own analysis, please. But that's the story on Georgia Capital.
Okay. Well, Ken, those are 4 great stock picks there, and I'm sure investors will be keen to look at them and do some more research. But at the start of our interview, we mentioned some ideas for getting more involved with Ken going forward. As I said, Ken publishes his daily views on markets, macro issues, and of course his numerous stock trading thoughts and ideas every day. He's going to be launching a subscription-based service in the new year. So if viewers are interested in joining Ken's distribution list and would like to take advantage of launch offers for the new service, can you please go to the address shown on the screen, branduk.net/contact, where you can fill the fields in and submit your details. Meanwhile, Ken, it's been fascinating hearing about your views on this month. I'm sure in December things will be very different once again. Meanwhile, Ken Baksh, many thanks for joining us again today.
Yes, thank you. And yeah, nothing stays the same in this world. Cheerio. See you early December.